Let's first understand how the rising wedge chart pattern develops. In this setup, buyers step in strongly at lower price zones and push the market upward. Once the price climbs to higher levels, early buyers who entered from below start taking profits. This profit booking causes a small correction, pulling the price down slightly and forming a swing low on the chart. Traders who missed earlier entries often buy around this swing low, pushing the price upward again and breaking the previous swing high. However, the price fails to hold at higher levels and pulls back once more. This time, though, it doesn't break the prior swing low and reverses upward, showing that sellers are unable to drive the market lower. When you connect the swing highs and swing lows with two trend lines, a rising wedge chart pattern becomes visible. In this formation, both trend lines slope upward, which is why it's known as the rising wedge pattern. Eventually, the price breaks this formation on the upside with a strong bullish candle and continues moving higher. There are two main variations of the rising wedge pattern: continuation and reversal. If the price sustains its previous uptrend after breaking upward, it is considered a continuation pattern. But if the price breaks downward and declines, it becomes a reversal pattern. Let's begin. Before moving into the strategy, if you found this useful, please give it a thumbs up. And if you're new here, subscribe to our channel and hit the notification bell so you don't miss our future uploads. We'll see you right after the intro and disclaimer. In today's video, we will study both patterns in detail and also analyze the psychology of buyers and sellers behind their formation. Let's begin with the continuation pattern. At market open, the price moves upwards slightly but encounters rejection at high levels, breaks its daily low, and declines. Taking support from the previous day's demand zone, it quickly rebounds and breaks the day's high, creating a new swing high on the chart. Buyers who entered near this support level earn good profits from this upward move, leading some of them to book profits as the price approaches its old day high. This results in a minor correction in price. Now it is important to understand the psychology of buyers behind this pullback. Around this support level, both retail traders and large institutional investors initiate long positions. Later, when the price nears its old swing high or day high, many retail participants book profits due to fear of a potential decline, causing the correction. However, if institutional buyers had fully exited here, the price would not have held at this point and would have dropped sharply. Since this did not occur, it indicates that a large number of sellers have not entered at higher levels, and only retail profit booking is responsible for the dip. Afterward, the price resumes its upward move and forms a higher low, creating a rising wedge chart pattern. Each time the price attempts to decline, it fails to break its old swing low. This indicates that buyers remain dominant and are unlikely to exit unless the price decisively breaks below its previous swing. Eventually, a strong bullish green candle breaks above this pattern and closes higher, also surpassing the old swing high. At this stage, you can plan a long trade by entering above the candle's closing, placing your stop loss below the pattern, and targeting at least a 1-to-2 risk-reward ratio. After some time, the price steadily rises and achieves the target. On this breakout, there are two possible entry methods for a long trade. The first is to enter immediately after the candle closes, known as an aggressive entry. This involves higher risk because breakouts sometimes fail, hitting your stop loss, but the reward is greater as you capture maximum points from the breakout. The second method is to wait for a retracement after the breakout and then enter when the price moves upward again. This method carries less risk but also offers a lower reward since the price may continue rising without retesting, causing you to miss the trade. Which approach you choose ultimately depends on your trading psychology and risk management strategy. Let us now see how the rising wedge pattern works as a reversal. From the morning session, the price has been climbing while moving in a strong uptrend, with buyers consistently pushing the market upward. At one stage, some participants book profits, causing the price to dip slightly, but it fails to break its previous swing low on the chart and resumes its earlier uptrend by taking support from the same zone. Once again, buyers drive the price upward, but this time it cannot fully surpass the prior swing high. This indicates that although buyers are still active, their numbers are limited, which is why the price is advancing slowly. For a while, the market continues rising with small candles and eventually breaks the swing high. Seeing this breakout, many new retail traders begin entering long positions, which is completely wrong. Now we can understand why entering long trades here is not the right decision. If you closely observe this chart, the buyers who had already entered long positions from lower levels have secured good profits, which leads them to book gains, causing the price to dip slightly. This shows that the number of buyers has decreased from this point to this point. For the market to push above this swing high, fresh buyers would need to enter with large long positions. Only then could the price move higher. While some new participants do enter the market here, their numbers are smaller compared to earlier buyers. Because of this, buying pressure weakens, and the price fails to rise significantly from this point to this point. Although the market continues to edge upward, if you look at the candle size, it becomes smaller, which means the momentum is fading. Now, if the price breaks its previous swing low, all the buyers holding long positions could panic, since the market has never broken its last swing low until now. After some time, a strong red bearish candle breaks the rising wedge pattern downward and also breaks the previous swing low. Notice here that the size of this bearish candle is much larger than all the earlier green bullish candles. This candle also triggers the stop losses of buyers who entered long trades during the breakout, forcing them out of the market in one move. Seeing this, the fresh buyers who entered in this zone panic and exit out of fear, creating panic selling in the market and driving the price downward rapidly. Along with this, the price also faces additional pressure, as the market fails to sustain above its previous swing high. Some sellers also add short positions at this level, further increasing selling pressure, which drives the price down with large red candles. In the same way, you should analyze the chart, study the psychology of buyers and sellers behind the different patterns, and then plan your trade entry accordingly. Stay alert to avoid such fraud. That's it, traders. Thanks for watching. I hope you gained real value from this video. If you did, make sure to hit that like button. It truly supports the channel and shows us you're enjoying the content. And if you're new here, don't forget to subscribe for more trading strategies. Thanks for watching, stay disciplined, stay consistent, and I'll catch you in the next episode.